In late 2007, post the collapse of Lehman Brothers and at the peak of the financial crisis, the global economy lost a collective of $2 trillion. But Warren Buffett was one of the few individuals worldwide who made more than $10 billion during the crisis. He invested $3 billion in a company in 2008 in return for preferred stock and warrants on General Electric. By 2011, his company Berkshire Hathaway received $3.3 billion as well as $900 million in dividends in just 3 years. Between the $300 million premium, the dividends, and the proceeds from the share sales, Buffett made about $1.5 billion in profit. By going against the tide and investing in companies that were severely undervalued at the time, he was able to make huge profits when the global economy rebounded. Contra investing, or investing against the prevailing market trend to earn profits, is a popular investing strategy that believes that markets are periodically driven to overvaluation and undervaluation due to the investor's herd-like approach towards the market.
Now, when you think about what does contrarian mean, the whole idea is to look for stocks, look for sectors that are currently out of favor, and essentially try to figure out which of those stocks or which of those sectors have the greatest potential to revert back to long-term average valuations. What I mean by that is that when you think of contrarian stocks, the most obvious contrarian stocks are the so-called value stocks. These value stocks are stocks with very cheap, optical valuations. Normally is at the heart of a contrarian strategy. To me, contrarian strategy is not appropriate for people with a short time horizon. On the other hand, if the investor is patient and has a longer time horizon, then you essentially can really still get very good returns from holding on to such stocks. Internally, we've decided that essentially roughly 50% of the fund will be in large cap stocks and the remaining can be in mid cap and small cap stocks. Inherently involves more risk because often the collective wisdom of the market is pretty good under most of the circumstances. So when you are adopting a contrarian strategy, you have to be very careful in terms of where you want to take a position that goes against this collective wisdom of the market. So that inherently means that the volatility of such a fund and the underlying stocks will be on the higher side. Whereas in a contrarian strategy or a contra fund, you will have a much higher representation of stocks that are not in favor at this point. So the inherent volatility of such a fund will be on the higher side. So if anyone is worried about, losing 10% or 15% from where they invested, this is not the fund for them. Someone who has a patience, someone who says that, I understand this as long as I can get a very good return over longer time frames. For people who have that kind of mindset, this is a very good fund in my opinion. The investor who invests in this fund should be willing to have their money be in this fund for a minimum 3-year period. Ideally, at least 5 years or longer. But in my opinion, less than 3-year horizon, people should really not be investing their money in a contra fund. Because the way it is structured, as I have mentioned before, these stocks can sort of give negative returns over shorter time frames. But it's basically the fact that you're willing to have the patience and you're willing to wait it out. That is what essentially allows you to earn higher returns. So anyone who invests in this fund should be willing to be invested in this fund for a minimum 3-year horizon. Ideally, in my opinion, 5 years or higher, but a bare minimum should be 3 years. Anyone thinking about less than 3-year time horizon should not be investing in such a fund, in my opinion. Every fund, in my opinion, has a very clearly defined philosophy. Now, the philosophies actually vary across funds. When I think about SBI Contra Fund and compare that with some of our other flagship funds like SBI Blue Chip Fund or SBI Focus Equity Fund, the investment philosophies are very different. So we do not have a common investment philosophy in our AMC. But what we do have is that every fund has a very clearly defined investment philosophy and the manager really abides by that. The way I think about the economy at this point is that we've gone through a multiple year down cycle where many sectors of the economy were sort of, in deep trouble or had a very subdued outlook. But now it feels like we are essentially approaching some sort of very key inflection point where we are just poised for a meaningful multiple year upcycle in these sectors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.